Hello traders, Gary Wagner here just after 10 o'clock in Honolulu, 4 o'clock in New York. It is Monday, June 16th, 2014, and this is the daily report for gold and silver. We have gold trading lower this morning, off about $3 on the day. It has had a high of $12.86 even. We'll talk about that because some of our subscribers did have a price order in to get out at 83. The low, 1270.10. Current print, 1272.60. As I said, putting it off about $3 on the day. Silver trading in essence unchanged on the day. Current print 1965 and change. The low 1950, the high 1995. Again, we had a price order in to exit this market for many of our subscribers. We'll talk about silver a little bit more towards the end of the show. Traders, there's no doubt we hit a brick wall last night when the market did run as high as about 86. As I said, we have pegged our current resistance between, call it 85 and 88 in that area. There's absolutely no doubt that when we did see this high, traders came in and sold that market. We talked about a couple of the reasons why we've pegged this as a level of primary resistance right now. One of the key reasons is the fact that it's a 50% retracement. It's a retracement from the large rally that we had, of course, beginning last year, culminating at 1391 in gold. Now, the interesting thing is the kind of candlestick that has formed from this. And this is a classic example of what is known as a shooting star. And a shooting star is the opposite of an inverted hammer. It is part of the umbrella group of candles. There are four different candles that make up that group: the hammer, the hangman, the shooting star, and the inverted hammer. Inverted hammer as well as the shooting star are identical in terms of composition. The differentiation between whether or not it's an inverted hammer or a shooting star is really where it's found in the market. As the market trades higher, of course, and that candlestick's form, it is a shooting star. If the market is headed lower, it would be something like an inverted hammer, such as you get something like this. This isn't a classic because the size of the tail is a little bit too long for the classic identification of that candlestick. Now, a shooting star is ominous, and it's ominous when we look at also silver having really a gapped star on our daily chart in the COMEX silver. As I said, we'll talk about that in a little bit. But for those traders that put in price orders at 1283, you exited the trade, you got in at 53, out at 83, a $30 profit. It's not too shabby considering that we're $10 lower now. Now, for those that are still in the market with this kind of an ominous move where we've got this shooting star, we are going to want to move our stop up very, very tight, maybe as tight as 1270, 1269. So if it breaks this low, we no longer want to be in, and we want to pull profits for any of those who did not exit the trade at 83. When we talked about this Friday, I said as a rule of thumb, I'd much prefer to trail stops up because it gives you the ability when you do get a big swing in the market to capture more of it. In this particular instance, as I look at it now, the move was probably to get out at 83. You know, it's very, very easy to be an armchair quarterback and look at a play after it's been accomplished. So I don't really want to do that because we've presented both of those strategies to you. But what I do want to say is that what we are getting is some real resistance. Now, the thing in terms of boding well, in terms of the market moving back up, is we have absolutely characterized this market. Let's go ahead and blow that up. But we've absolutely characterized this market as a market that has been really moving in spurts, consolidating, then taking a move up, consolidating, taking a move up. And so really what we're looking at is a consolidating candle. When you consider the highs and the lows of some of these candles, they have been fairly extreme, so that's not out of the realm right here. We do have a scenario that continues to brew in Iraq. It's by no means resolved, and if anything is heating up. I think that one thing right now that is really tapering any kind of larger move in the gold market right now is the FOMC meeting, which is scheduled to start tomorrow. As you can see, what I have done is converted our daily chart, which was in standard candlestick format, and converted it to our Japanese average chart. When we do that, that red goes away because, of course, we're comparing it to the midpoint. Midpoint is always the starting point of the current candle. If it trades below that midpoint and closes below that midpoint, of course, it goes red. If it trades below the midpoint but closes above the midpoint, as you see with this tail here, you get a tail. And so that's the key differentiation. When we look at it through the eyes, of course, of a Japanese average chart, it certainly doesn't look nearly as ominous as what we saw when we looked at it in a standard traditional candlestick that, of course, has true opens and closes. So as I said, we're going to be raising our stops today for those that are still in the market. There's no doubt that we want to protect our profits that we already have. We also want to be able to continue to have profits. If you're still trading in this trade, you didn't get out at 83, of course, and be able to capture the maximum amount of profit potential. Now, for those that did exit the trade, my recommendation would be to get a little distance on it before re-entering the market, see what happens at the FOMC meeting, and then carry on from there. We'll put out a recommendation if we think you should re-enter the market. As I said, I prefer to trail stops up. What you miss is this kind of a move where literally the price that we put in was very close to the top of the market. But also realize the market's only trading right now about $10 below that. It is well off of the highs, but at the same time, when we look at it through the eyes, as I said, of a Japanese average chart, you can see that it still looks as though there's a lot of steam in the market, especially when you compare it to the midpoint of Friday's trading activity. Silver. We are looking at a daily chart. This is the COMEX silver. If time permits, I do want to put up the cash market or spot market silver because it does look different because you don't get the true opens and closes that you get with this COMEX. You get that continuous stream. But you can see, in essence, we've got this gap up. We make this new high. We have pegged our current resistance right now really at the tops of these markets right in here. It takes us just below $20 per ounce. We have this top at around 80, and the market is trading genuinely unchanged today. For those that got in at 1903 and got out where our price order designated that we should get out, you received a pretty decent profit. Because the key on this is we got in at 1903. If you put a price order in, our recommendation on the price order was 1978. So you were really able to capture a good percentage of this move, roughly 75 cents on the trade. Again, we will be putting out some sort of a trade alert for those that are still in the market long. Good profits here, good profits in gold. So I'm comfortable with either call on this particular trade or play. This has been Gary Wagner wishing you as always good trading. We'll talk to you tomorrow on Tuesday for another daily update and review. Bye-bye.